Hello everyone. In this video, we're going to talk about an economic indicators update, why recent risks have reset, and why this is not a recession. Just a few weeks ago, recession risk was flashing red. Today, the data tells a very different story. A few weeks ago, recession risk was flashing red. Today, the data tells a different story. Key macro indicators are improving. Liquidity is flowing again. Markets have quietly shifted back into an expansionary phase. Valuations are still high, but this is a risk reset, not a recession. Let's break down what changed, what didn't, and how I'm positioned now. Here's where the data stands right now. Manufacturing PMI is back above 50. The yield curve is positive and steepening. Credit spreads remain well below stress levels. Liquidity is rising. These are not recession conditions. Here's what the data is actually saying. Manufacturing is back in expansion. The ISM PMI is above 50 again, signaling improving activity and lower near-term recession risk. Credit markets are calm. Spreads are well below stress levels, telling us lenders are not worried and financial conditions are easing. Liquidity is rising. Net liquidity is moving higher, and markets fall when liquidity is removed, not when valuations are high. The yield curve confirms late cycle expansion. Late cycle does not mean imminent recession. Labor is cooling, not breaking. The SOM rule remains in yellow territory. Valuations are the real risk. Returns may be capped, volatility elevated, but liquidity is still supportive. When you combine everything, expanding manufacturing, calm credit markets, a positive yield curve, and rising liquidity, with elevated valuations and mild labor softening, the conclusion is clear. This is expansion, not contraction. Recession risk is around 40%. The market regime is business as usual. This is not a panic environment, but it's also not a reckless YOLO setup. Here's how I'm positioned right now. Core exposure stays intact, with a risk-on bias and discipline. I'm trimming overextended tech, tilting toward dividends and quality, and keeping 10 to 12% in cash. My core ETF is VOO. Growth exposure is VGT, trimmed. And for income and defense, SCHD. No SPY puts, no VIX hedges, no crash positioning. Liquidity support is active. Hedging isn't necessary here. This is not the start of a new bull market driven by fundamentals. It's a liquidity-supported expansion in a late-cycle economy. That means stay invested, manage risk, don't chase, and don't panic. When the data changes, we adjust. Right now, the data says stay calm, stay invested, and stay disciplined. Thanks for watching Eshmont. Like, share, and comment. See you in the next video.